So you're right when you say that your traditional investments or assured returns products, the returns have come down.
Right.
And if you look at history, in the 90s, people were getting double-digit returns from assured returns, and you were not required to look at alternative
Right.
avenues. But when you look at the returns from these products today, certainly people are looking at alternative avenues, and mutual funds is one of the choices that is being explored. So if I need to explain this, I would say that mutual funds certainly provide a good amount of variety in terms of debt products. To give you an example, say for example, there are liquid funds, which are at the lowest end of the risk spectrum. So if you look at products across the risk spectrum, and you can invest in various debt products depending upon their risk appetite and investment horizon. So if you look, so liquid funds are short-term products. You can invest in them for less than 3-month investment horizon. You can park your contingency funds in them. You can park some of the money that you have in your savings bank account, money that you need over a very short period. So these are some of the products that can help. There are products like accrual funds, which help to provide more stable returns, and you can park your money for even the medium term. So besides variety, mutual funds offer convenience. There is a lot of transparency. There is good amount of regulatory regulations that support mutual funds. And having said that, even if debt funds were giving the same returns as assured returns products, you would find that if you look at tax efficiency of mutual funds, and look at investment horizons which are beyond 3 years, you will notice that for the same amount of returns, mutual funds would be more tax efficient, because one is you get to claim indexation benefits, which is nothing but inflation adjustment. So for example, if mutual funds are returning 10% and inflation over that period has been 5%, you pay tax only on the remaining 5%. But if you look at your traditional products, you need to pay tax on the interest that you earn every year.
Right.
You have to, whether you redeem it or no, you have to pay tax on all the interest. You have to add that interest to your income and pay the tax.
Absolutely.
And you pay it at your tax slab. So if you are in a 30% bracket, you pay tax at that rate. But coming to mutual funds, if you hold it for a more than 3-year period, you get the benefit of long-term capital gains and indexation benefits. So long-term capital gains are 20%. Of course, you'll have the applicable surcharge and cess, but which is lesser definitely than the highest tax slab. So if you look at it from a holistic perspective, there is definitely merit in looking at debt mutual funds.
Right.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.